So, hello, 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 and a massive hello to everybody. Hope everybody's having a great day wherever you are, whatever you may be doing. It's 50 pips, rocking and rolling, 23rd of August, 2019. No trade calls, no recommendations, every response for their own stuff. Here for educational purposes only. So, what's going on? So, again, more of the same. We're all waiting for Jackson Hole. And as we said, right after that risk of the FOMC minutes coming in more hawkish than everybody expected based on the fact that a lot had happened since then, we're still seeing that kind of pattern play out, right? And we're seeing a lot of the FOMC members that actually voted for the cut kind of talking it back, or basically even these doves were saying that they were reluctant when they voted for the cut because all things being equal, the economy is still doing fine, right? So it's going to be hard today for Powell not to sound hawkish, or at least less dovish than the market is expecting. If you remember, we've been talking in detail how the market's been putting very, very lofty expectations, and this is reflected actually, in the odds for the next cuts, right? So, the odds for September cut is still over 90%, but the odds for a cut in October has gone down from almost 70% to just under 60%, and the odds that the Fed was going to cut every single meeting until the end of the year went down from above 40% to about 30%. So clearly, there's a little bit of there's a little bit of risk there, right? So the big question is, how is the market going to react based on the fact that the market has put these very lofty expectations? So right here, what does the market want? The market wants Powell to come out and say, we got your back, right? We are going to be aggressive. Even if the economy is ticking along finally, we are going to be aggressive. Don't worry, right? And if he delivers this message, we'll get the usual more with, stocks ripping higher, et cetera, et cetera, et cetera. And especially if the ECB, governments around the world are all keep on talking about, more fiscal stimulus and more QE, the start of QE, this is still remains the path of least resistance. What we have been discussing is the fact that stocks look tired. It looks like they're having trouble buying this, and we're still seeing a lot of mixed messages. That's why we have been tactically long, but trying to play for these short dips. So as we've been discussing in the webinars every morning, we've been pretty much selling the open and then trying to buy these for those rallies back towards the end of the day, and that has been working very tactically, waiting for a bigger swing opportunity to set up, right? So the other thing to keep in mind is that it's not really going to be all clear after today, because we have risk of more headlines in the market and more opinion pieces, commentary throughout the weekend with Jackson Hole and the G7. So that's something which you really have to be aware of. But especially today, in terms of stocks, there is a risk of us seeing a kind of buy the rumor, sell the fact event. And the two key considerations I think you have to have here is also, with everybody not only having these lofty expectations from the Fed, is everybody's expecting also very lofty expectations for the ECB to start QE again in September again. But the big question is, how aggressive is the ECB going to be, and what incentive does the ECB to do something ahead of understanding how things are going to evolve or go into that October deadline on the Brexit, right? Because it might be a lot more smarter, it might be more prudent to wait and see what happens there to keep a little bit of ammunition. So these are things we're going to discuss in today's webinar also. So looking at the trade side, we still think that the biggest surprise could be a counterintuitive reaction on the euro, right? And in terms of bonds and golds, keep in mind that there will be people still fighting to buy the dips aggressively. So we wouldn't expect to see kind of end of the world scenario on the bonds or on gold, but we are, we're short for a correction, right? And which hopefully will offer some much nicer buying opportunities. But again, the risk here is to see a little bit of short-term dollar strength, as we've been seeing based on all these comments and this, less dovishness or more hawkishness we discussed. And this is fairly evident by the action which we're seeing on USD JPY and USD CHF, which have been very nice longs recently, and this pullback in gold and in the bonds. Again, I think we also mentioned the fact to be careful on GBP USD, because if anything, it looks like the risk is for the headlines to project this higher, possibly all the way back up into the 124s, and there's some interesting trades to structure around there, even though you have to be very, very nimble. And again, euro is stuck in that, whole range going back down, if you want to call it 111, 110 range. But if it hasn't gone down, and if it can't go down in the midst of all the things that are going on in Europe, around the world, with USD CNH, with political uncertainty, and with this new kind of reaction to Fed communication, well then, the path is likely sideways or higher. Remember, everybody always talks about price going up or down. Price can do three things. Price can go up, price can go down, or price can go sideways, right? But the more it manages to sustain all these shocks, the more interesting it's going to be to play for surprise upside, even though it may be a counterintuitive trade, as we've been discussing recently. Okay, guys, I hope this was useful. Again, if you like these, please like the YouTube video, so I know I'm not wasting my time, taking some time out of my day to do these and post these. And if people like them, I'll keep on trying to put these out each day. Have an awesome one. Take care, guys. Bye-bye.